as well as dividends. So one thing I want you to understand when it comes to risk versus reward is investing always comes with risk. There is not a single type of investment out there that has no risk. You know, a lot of people consider bonds, for instance, to be the least risky types of investments. And so let's just say you take out a 2 or 3% bond from the US government. Well, historically speaking, almost every single empire that has ever existed eventually ends. And so if the US government issues a bond and then you take out that bond and then it ends like 5 years later, something happens in the world and the US government no longer exists, then your bond is probably going to be worthless. So even the investment that most people say is the least risky still has some risk. However, with that being said, higher risk can mean higher return, and lower risk usually means lower return potential. So what you really want as an investor is the types of investments that have the least amount of risk and the highest upside. And generally speaking, it's better to take more risk as an investor when you are young. The reason for this is because of the fact that when you are getting close to retirement age, when you're getting older, if your portfolio takes a huge hit, you may not have enough time to recover from that before you retire. Because when you retire, you will of course be withdrawing money from your investment portfolio in order to pay for your daily expenses. So generally speaking, you're supposed to take more risk while you're young and then take less and less risk as you get older. Now, when it comes to evaluating how a company is doing, one of the biggest and most important things that you want to look at is what's known as the quarterly earnings report. This is a report that is submitted 4 times a year in what's known as Q1, Q2, Q3, and Q4. And this would approximately be the first 3 months being Q1 and then the last 3 months being Q4. And on this report, you have some very important numbers. So you've got your net sales, which is the gross sales minus the returns, allowances, and discounts. And then you've got your net income, which is the gross income minus the expenses. So just a very simple example of net income. Let's say the gross income is $100 million, but the expenses were $10 million. The net income would be $90 million. And then you've got your earnings per share, which is a company's net profit divided by the number of common shares. And this is basically an indicator of how profitable the company is. So quarterly earnings reports can be very good to look at. They're also extremely easy to understand, whereas some of the other stuff we go into a little bit later on is a little bit more difficult. Now, I'm going to briefly touch on economics because I think it's incredibly important to understand. And economics, very simply, is the study of how society uses its limited resources. And in financial terms, it is the science that studies the production, consumption, and distribution of goods and services throughout society. Now, there is a really big distinction here between microeconomics and macroeconomics. Microeconomics focuses on the interactions between individual entities. So for instance, the interactions between consumers and a business. Macroeconomics has more of a big picture focus, and it looks at broad issues such as inflation, unemployment, gross domestic product, government spending, government deficits, etc. So microeconomics is kind of a bottom-up sort of approach, whereas macroeconomics is more of a top-down. Microeconomics focuses on the trees, whereas macroeconomics focuses on the forest. Now, I think both of these are incredibly important, and I think in order to have a well-rounded perspective, you should be able to look at things from both different ways. However, with that being said, the most important concept to understand in economics is supply and demand. Supply and demand is to economics what gravity is to physics. And basically, supply is the amount of services available on the market versus demand being the amount of goods and services that people actually want. And supply and demand is incredibly important in economics and also just making decisions in your life in general. I see this a lot with people when I'm trying to give advice on college degrees. There are certain college degrees that for whatever reason, everybody goes for. Everybody wants to get into certain types of college degrees, even though the demand is not there. And so they get the degree and they find out that they're not able to get a job in anything related to that degree. And then there's other majors out there that nobody's going for, and there's tons of demand, right? There's tons of jobs. And this is the same for different types of products that companies look to sell. And where these two curves meet, the supply and demand curve is basically the market clearing price. And if you try to go against this overwhelming force, it's almost like trying to go against gravity, right? You try to jump up and go against gravity, eventually it's always going to drag you back down. So if you try to create a business where you're selling a product that has almost no demand, it's going to be incredibly difficult. Another way of looking at this is if you go into a market that's already saturated, a market where there is already a ton of other businesses selling that same exact product, and you don't make your product special in some way to where it's different, then you're also going to be suffering there as well, because there's a ton of supply and it's already met the needs of the demand. It's met the wants and the needs of the people within that market. So can't emphasize how important supply and demand is. It's basically one of the things that makes the world go round. Inflation is another thing you hear about all the time, especially lately. And this is basically the decrease in the purchasing power of money over time, or inversely, the increase in the price of goods and services over time. So an example of inflation is, in the 1970s, a cup of coffee was about 25 cents. Now it's $1.59. And let's be honest, if you go to Starbucks, it's more like $5. But yeah, I think you get the point. This is where your fiat currency, like the US dollar, becomes less and less valuable over time. And generally speaking, inflation happens at around 1 to 3% per year. Many think that this is a healthy amount of inflation to keep it at around 1 to 3%. However, when it gets higher than this, bad things can happen. And we've seen inflation get totally out of control, like for instance with the Zimbabwe dollar, where you could barely buy like a loaf of bread with $1 trillion Zimbabwe dollars. And it's even starting to get a little bit out of control in the United States right now. And so I think everyone can agree that too much inflation is a bad thing. Now let's go over the difference between industries, sectors, and markets, because these are 3 terms that you are going to hear thrown around a lot. So an industry is a group of businesses producing related products and services. So an example of this, you would hear this said on TV, for instance, would be the automobile industry, or the mining industry, or the clothing industry. A sector, on the other hand, is a broad group of industries. So for instance, you might have the health sector, or the energy sector, or the consumer staples sector. So you might have the clothing industry that is within certain stores. So for instance, Target sells lots of clothes. However, in that example of Target, the sector would be consumer staples, because they also sell lots of different types of things that people need, like food. And then a market is a group of customers that are interested in a specific product or service. So this is a different way of looking at it, because you're coming at it from the customer's perspective. Instead of coming at it from the business's perspective, where you're selling certain products or services, you're coming at it from the customer or consumer's perspective, where you're buying certain types of products or services. And I really like this quote from Eugene Schwartz, who was an incredibly talented copywriter. And it's the power, the force, the overwhelming urge that makes advertising work comes from the market itself. So this is basically just a way of saying that when a company is trying to sell a product, it's much better to listen to the consumers and ask them, what do you actually want? Rather than trying to sell a product and convince the consumers that that product is what they want. So it's much better to listen to the market rather than trying to shape the market. Now, dividends, these are things that we've talked about several times in this video, and you probably already have an idea of what this is. And this is basically where when you own a share in a company, they actually pay you out cash payments. Now, most of the times dividends are paid quarterly, and they tend to be between 0 and 10%. So for instance, AT&T has a 9.11% dividend yield. So that means they pay 9.11% per year on their dividends. And so an example here would be, let's say a company says that they're going to pay you $1 per stock that you own in that company. And this stock is going to be paid out quarterly. So that means if you own one stock, you would get paid around $4 annually, $1 each quarter. If you had 10 stocks, you'd get paid $40 annually. And if you had 100 stocks, you'd get paid $400 annually. Now, if you own stocks in an individual company, usually this would get paid into your investment account. And you can either leave the money in your investment account or you can have it automatically